What's up, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be taking a look at Verizon stock, ticker VZ. This stock has been beaten down both on the 1 year and on the 5-year chart, but their dividend is over 6% right now. So we're going to take a look to see if this stock is currently a good investment. So first thing, if we get a better look at the stock chart, we're going to see it's down 28% on the year, and it's down 22% in the last 5 years because this stock was normally trading at about the $50 to $60 range, and now it's been sitting at the $35 to $45 range. So it's down a lot, and the market cap is now $162 billion. The price to earnings is a little bit under an 8, and the dividend is over 6.5%. So if we take a look at my chart here, let's go to revenue and net income. We're going to see they've done a great job growing revenue and net income. No problems there. 2022 saw $136 billion of revenue, along with $21 billion of net income. And we see them growing both revenue and net income pretty nicely. So those are both going to get a check. If we take a look at number 3, we're going to look at the price to earnings, and how we saw it's sitting at about a 7.7 right now. And that's based off of 2023 numbers. It's sitting at about a 8 forward PE ratio, maybe even a 7, on a forward basis. So that's cheap. That's pretty much cheap any way you look at it. Here's the history of their price to earnings ratio. You can see all the way back to 2014, the lowest it goes is it dipped down to a 5 in 2018. And then normally it'll come to around a 7, and it's been as high as 14. But I would say the average is probably somewhere around a 9 or a 10, right? A 10 is probably the average. So if we're looking at it from that perspective, we can say, okay, they're going to do what? Let's say they do $4.70 of EPS. They're expected to do it for this year and next year. That puts the stock at about a $47 price range. So that's where I feel the stock would be. That's probably a fair valuation for the stock. If we get to the next one, we're going to see, I would consider this company to be maybe not so much innovative. Maybe back in the day they were innovative. As long as they're keeping up with things like, going from 4G to 5G, things like that are important for this company. But other than that, they're not really branching out in too many other aspects. As far as the moat goes, I would consider this company to have a huge moat. For one, they have 143 million subscribers. That's not easily done. There's not some startup company that can just start up a phone company and come out with 140 million subscribers. That takes a long time to build that up. We're going to look at the growth rates later, and we'll take a look at that chart later too. So overall, I would consider that to be their main moat. Is really, there's only so many major players. There's smaller phone companies, but like Verizon, AT&T, and Sprint, T-Mobile, those are the big ones. Those are the big names. Is the industry growing? Yes. If you look at the regular phone, the wireless phone service, it looks like it's going to grow at about 6% a year. But if you look at the broadband service, it's expected to grow 10% over the next 7 years. So they're in both of those industries. So they should be, as long as they're growing somewhere between that 6 to 10% range, that's good. That's what they should be doing. But if we look, they're actually only expected to grow about 1% this year and the next. So that's not a great sign. That means that they're falling behind or losing market share. Something is off there. Doesn't mean it's the end of the world. I also believe another part of their moat is corporations like this. It's almost like it's impossible for them to lose. Now, I'm not saying that it's guaranteed that like the government would, backstop them if they were going out of business, but I wouldn't be surprised if something like that happened. There's companies like this that have, millions and millions of customers in the United States, and their business model is so important that it's hard to see them going under. So, that's something to consider too. As far as return on invested capital, if we go down to ROC, what we're going to find is that the numbers are strong. Last year they did 9%, which is not bad at all. That's good. And then and typically during all these years they were doing anywhere from 10 to 16%. So those are definitely strong and healthy numbers. Healthy cash flow, I put no. This is pretty much their only problem with this stock that I'm finding. I do own several shares of the stock. just to disclose that. But if we look at the cash flow here, well, the operating cash flow is not a huge problem, right? It's hovering around 35 to 40 billion. That's not really the problem. The problem here is, for one, they're investing a lot of money, and their free cash flow has come down significantly from 16 to 21 billion in 2019 to 2020. Then somehow we saw a negative 28 billion, and then now we're down to 10. So we definitely need to see a big improvement there in 2023. So hopefully we're going to see that. If we come down to, I mean, I think another big thing here is CapEx. CapEx it's kind of taken up a big chunk of their cash flow. So those are things to watch out for. So yeah, it's not ideal. It's not perfect. It's definitely not a perfect cash flow statement. But again, out of all the things I was talking about with their moat, the type of company we're talking about here is one that isn't subject to going out of business like a lot of other companies. So I believe you're protected in some ways when you're talking about Verizon. Diverse revenue streams, no, I would not consider this to be diverse. We're looking at Verizon's wireless segment to make 80% of their revenue. That's not, if that business weakens or they're losing market share, they don't have anything to back them up there. Like that's gonna be a major, that's pretty much their whole business. That's 80%. That's gonna be a major hit to their top and bottom lines. Growing equity, yes, they are growing equity, so I guess that's a good sign. Although, okay, equity has gone from 62 to 92 billion, right? That's great. But you have to look at things like, okay, so what is it? Plant, property, and equipment is looking strong, right? That is a good sign. 114 billion to 133 billion dollars worth. That's good. But this goodwill, that's not, I don't like seeing 189 billion. That's half of their assets in goodwill. I don't like seeing that because that can fluctuate so much, and that's not a tangible asset like I like to see. So it's not great there. And if you look at their debt, so total debt of $176 billion. And if they were to pay off what they have with cash, they would still be left with $148 billion. Now, AT&T has this exact same story. So it's not like the other competitors are doing that much better. AT&T's might even be worse. So keep that in mind too. I don't think both of those companies are gonna go under. They're gonna have to stay operating so that people can have phone service. Number 10, it's definitely over 15% of the market cap. Not a problem there. Share count decrease, no. This one was a little bit disappointing. This type of company should be able to buy back shares. I guess you could look at it from the perspective of they're really putting all their resources into providing that 6.5% dividend. And it's not like they're increasing shares a huge amount. It's only going up by like 1 or 2% per year. So not a huge deal there. You are getting a 6.5% dividend. Healthy amount of debt, as we just looked at, no, it's not. Respectable management, I'm going to put no, because for things like the balance sheet, really just the balance sheet, that's the main thing. They need to get rid of that debt. And as long as they do that, everything is good. Their ROI is good. The share count's not out of control. Their dividend is strong. It's 6.5%, and they're not paying out more than what they can afford. So it's healthy. Number 14, are the current assets more than average annual income? Yes, the average annual income is, I think we're looking at 15 billion here or so, 15 to 22 billion or so, and current assets are 37 billion. So that works for me. Healthy dividend, how I just said, yes, we're talking a 6.5% dividend with a payout ratio of 51%. That's not bad at all. Is it over 20 years old? Yes, it is. It was founded in 1983. So all in all, this is going to get 11 out of 16, which technically is not considered a buy, right? But I still bought the stock anyways because I want that 6.5% dividend. I don't think the stock's going to stay at $38 a share forever. I do think it's going to come back to $50 or $60 a share. And I think it's only a matter of time. It might take a year, it might take 2 years for that to happen, but I don't see the stock going to $25 a share or anything like that. I can't imagine that happening. And we're talking about a P ratio of a 7 or an 8 right now. That's cheap. You're getting good value for what you're paying, and you're getting Verizon. Verizon's everywhere. They have 143 million subscribers. So I don't really see a huge risk here. They do need to take care of that debt. problem, but again, a lot of companies have that problem, like AT&T. And most of the time, when these big corporations that are worth 50 billion, 100 billion, 200 billion dollars, if they're ever on the verge of bankruptcy, the government normally backstops them and helps them out, or they find some way out of it, right? They dilute shareholders, or they take out a loan, or something happens to where they're not going under. So just some things to consider there. But overall, I like the stock. I'm not going to recommend you buy it, but do your own research and make your own decision. But thank you guys for watching. If you have any ideas, any suggestions, comment down below, and I will see you guys in the next video.